The architecture of permanent wealth. What they never teach you. You are 29 years old and you are good at your job. You cover mid-sized industrial companies at an asset management firm in a major American city. You manage 8 equity positions inside a multi-billion-dollar fund. Every morning you arrive before the market opens, read earnings releases, pass management commentary, wade through research reports that mostly confirm what the consensus already believes. You think your job is to find where the market is wrong. That belief is about to be fundamentally revised. The call arrives on a Tuesday afternoon, just before the close. An unfamiliar number. The voice on the other end is calm in the specific way that people are calm when they have never needed to be otherwise. The man introduces himself as an advisor representing a private family office managing several $1 billion in assets. The family holds a significant stake in one of your 8 companies. He would like to meet before the end of the week. You'll go. The first meeting. The office has no signage on the building. The elevator requires a key card. The advisor, a man in his mid-50s, silver at the temples, open collar, no tie, pours 2 glasses of water without asking and sets a folder on the table between you. Inside the folder are your last 3 quarterly research notes on the company, annotated in blue pen, not highlighted, annotated. Someone has been reading your work carefully and thinking about it. The family purchased their position in this company 11 years ago at a price that now represents a gain of more than 600%. It trades today at a number that by any conventional metric suggests full valuation. You ask the obvious question, with a return like that, why not sell? Basic portfolio discipline. The advisor looks at you the way an experienced chess player watches a newcomer move their queen into danger. He says, walk through the tax calculation with me. Federal capital gains at 20%. Net investment income tax at 3.8%. State tax at roughly 5%. On $280 million in unrealized appreciation, a sale produces approximately $80 million in permanent tax liability. Gone. Irretrievable. You say, that's the cost of realizing the gain. He says, or it's the cost we choose not to pay. He slides a document across the table. A lending facility against the position. $190 million at 3.4% annually. No sale. No tax event. The family has full liquidity. The asset continues compounding. They never gave it up. You are quiet for a long time. He says, our objective is to make sure we never have to find another great investment again. You take the engagement. You do not fully understand what he means yet. Your education has begun. Year 1. The architecture. The first year is technical. You work on the family's overall asset structure, not allocation in the conventional sense, but something far more foundational. How legal entities hold assets. How tax character flows through different ownership structures. How appreciation passes to the next generation without triggering the tax event that would otherwise diminish it. Real estate held through a series of separate legal entities, each one a distinct container. Equity positions held in trust, structures designed so that the cost basis resets at depth, meaning the embedded gain. The appreciation accumulated over decades is eliminated for heirs entirely. The government never touches it. A stake in a private credit business where management profits are taxed at long-term capital gains rates rather than ordinary income. Every asset chosen not merely for expected return but for its tax character and its utility as collateral for future borrowing. This is not a portfolio in the sense you learned. It is a machine designed to generate spending power indefinitely without ever triggering the event that diminishes it. One night alone in the office you modeled 2 scenarios side by side. Scenario 1. The family sells their position, pays the $80 million in taxes, and reinvests the remaining capital at 8% annually. Scenario 2. The family borrows against the position at 3.4%, retains the asset, and lets it compound at the same 8% annual return. You run both scenarios forward 30 years. The gap between them is not marginal. It is not a rounding error or a modeling assumption. It is generational. Hundreds of millions of dollars in difference. Not from a better investment. The return assumption is identical in both cases. The only difference is what the family refused to pay. The math is not subtle. Once you see it clearly, it is almost brutally obvious. You wonder briefly why no one teaches this. Then you stop wondering. You understand why. Year 2. Permanent income. In the second year you are introduced to a different family. Third-generation wealth. A network that operates entirely through referral. Their holdings include infrastructure assets, the kind that generate cash every month regardless of market conditions. regardless of interest rate cycles, regardless of whether equities are up or down. The family calls this permanent income, income that cannot be stopped. In one meeting, the family receives a compelling offer to sell a utility business they have owned since the late 1980s. The buyer is credible. The multiple is fair. Implied sale price approaching $700 million, closing in 60 days. The family's cost basis in this asset is approximately $18 million from the original purchase nearly 4 decades ago. The patriarch does not ask about the buyer. He does not ask about the valuation multiple. He asks a single question: what can we borrow against it today? The answer is approximately $290 million at current rates. He says, that's enough for the next project, and thanks everyone for their time. You sit with this on the drive home. The offer was never real to him, not because he could not use $700 million, because selling is not a transaction to him, it is an ending. Every asset is a permanent claim on the world's productive capacity. To sell it is to trade a permanent claim for a temporary sum of cash. Cash that will be taxed when it arrives. Cash that will erode from inflation while it waits. Cash that will eventually be reinvested somewhere, at some unknown future price, under some unknown future tax regime. You walked into the meeting thinking about exit strategies. You walked out thinking about forever. Year 3. Moving the pieces. By the 3rd year you are no longer observing. You are constructing solutions. A technology founder holds over $1 billion in a single equity position. He cannot sell without collapsing the stock price and simultaneously triggering a tax event of catastrophic proportions. The position represents the majority of his net worth. It is completely illiquid in any practical sense, despite appearing on a public market. The solution involves contributing the position to an investment partnership alongside positions from other investors. The gain is deferred entirely. Legal work takes 4 months. Professional fees alone run into the millions. When the transaction closes, the founder calls to say he feels like he found a move that most people do not know is available. He is right. You begin to understand debt differently, not as risk, as a tool, a mechanism for creating liquidity from illiquid assets without triggering a tax event, without selling, without surrendering the compounding. The very wealthy do not think primarily about portfolio volatility. They think about collateral quality. A piece of real estate generates rental income, but it also serves as security for a credit facility. That credit facility funds the next acquisition. The next acquisition eventually serves as collateral for the one after that. The assets are not a stack. They are a structure in which each element supports the others. Removing one piece does not simply eliminate its contribution. It weakens the surrounding architecture. You stop thinking in individual positions. You start thinking in systems. Year 4. Structural power. In the 4th year you are brought into an advisory role on a corporate restructuring. A publicly traded holding company is facing pressure from an activist investor demanding the sale of real estate assets. The activist's valuation analysis is correct. The logic is clean and rigorous, exactly the kind of analysis you produced when you believed that price discovery was the point of the exercise. You are no longer on that side. The controlling shareholder holds a 41% stake. 2 generations of family ownership. Cost basis negligible. Embedded appreciation approaching $1 billion. A sale would produce over $250 million in tax liability before a single dollar could be reinvested. It would also permanently sever an income stream generating tens of millions of dollars annually. And it would surrender decades of accumulated influence over significant commercial real estate markets in multiple cities. That influence does not appear on a balance sheet. He cannot model it in a spreadsheet. It is structural power compounding not in dollars, but in access, relationships, and decision-making authority. He built the defense, a recapitalization that returns capital to shareholders without requiring asset sales. A restructuring that offers the activist partial liquidity without forcing full disposition of the assets. The activist accepts. The family retains the assets. The income continues. The control remains. The advisor looks at you afterward and says simply, "Now you understand." You do. What they understand that most people never learn. The city blocks remain. The income stream continues. The game moves forward. The wealthy do not sell because every sale is a permanent subtraction. Real wealth of duration is built on the consistent refusal to subtract. An asset generating income, serving as collateral, and compounding over time is categorically different from cash. Cash is inert. It is taxed when it arrives. It erodes from inflation while it sits. It must eventually be redeployed at an uncertain future price. An asset is alive in a way cash is not. A well-chosen infrastructure investment does not stop generating returns because its owner is having a difficult quarter. The sophisticated owner borrows against it at an interest rate lower than the asset's yield, keeps the spread, and compounds the difference into the next acquisition. The tax code is not a fixed constraint. It is a variable that responds to structure. The family that sells pays. The family that borrows does not. The family that holds until death transfers the asset with a reset cost basis. The government never touches the accumulated appreciation. This is not evasion, it is architecture. Legal, deliberate, and designed generations in advance. Every family of lasting wealth has an architect. Most people never know the architect exists. The gap nobly explains. Here is what standard financial education teaches. Diversify your portfolio. Rebalance annually. Take profits when positions become oversized. Pay your taxes and move on. The discipline of selling at the right time is presented as a virtue and a sign of financial maturity. Here is what the advisors showed you in that first meeting. Selling is almost always the most expensive thing you can do with an asset that is working. Consider the math from a different angle. Two investors each hold an asset worth $1 million with a cost basis of $100,000, $900,000 in unrealized appreciation. One sells after combined federal and state taxes at roughly 30% of the gain. He has approximately $730,000 to reinvest. He has paid $270,000 for the privilege of converting a productive asset into cash. That cash now sits waiting to be deployed somewhere, at some price, under some future set of conditions he cannot predict. The other borrows $300,000 against the position at 4% annually. He retains the full asset. He has $300,000 in liquidity to deploy into the next opportunity. The cost of that liquidity is 4% on $300,000, $12,000 per year, while the underlying asset earns 8% on $1 million, which is $80,000 per year. He is borrowing at 4 to earn at 8. The spread is his. The compounding is his. The asset is his. Over the following decade, the investor who sold is compounding on $730,000. The investor who borrowed is compounding on the full $1 million, while servicing interest that costs meaningfully less than the asset earns. The gap between their terminal positions grows larger with every passing year. After 20 years, it is not a small number. After 30 years, it is a different category of outcome entirely. The sale was not portfolio discipline. The sale was a very expensive decision dressed in the language of prudence, and because the cost never arrived as a visible bill, because it appeared instead as a smaller future portfolio, almost nobody ever fully registers what it cost them. Why most people never see this. The architecture of permanent wealth is deliberately difficult to perceive from the outside. Most of what appears in personal finance education is designed for the accumulation phase: how to save consistently, how to invest in diversified low-cost funds, how to avoid common behavioral mistakes. That advice is correct and genuinely useful for most people at most wealth levels. It is not wrong. It is simply incomplete in a way that becomes very expensive at a certain scale. But it does not describe how wealth at genuine scale is built, maintained, and transferred across generations. That conversation happens in offices with no signage on the building, in meetings that do not appear on public calendars, in legal structures that require years of specialized knowledge just to recognize, let alone construct. The people who build and maintain generational wealth are not primarily focused on finding better investments than the market offers. That search matters at the margin, but the margin is not where the real difference is made. They are focused on architecture, on constructing systems that generate, preserve, and transfer wealth with the minimum possible friction at every stage of its life. The investment selection matters, but the structure around the investment matters more. Which legal entity holds the asset? How gains flow through the ownership structure at different stages? What the asset can secure in terms of credit, at what cost? How control is maintained and transferred across a generational transition? What the tax profile looks like, not today, but over the next 20, 30, and 40 years, under a range of possible future tax regimes. These are not questions most financial advisors are trained or equipped to answer. They are not questions that appear in mainstream financial media, because mainstream financial media serves the accumulation market, not the preservation market. Nor the preservation market. They are not questions taught in standard curricula. Because the people who understand them have no particular interest in teaching them broadly. They are the questions that determine the difference between wealth that survives a generation and wealth that defines one. The gap between the two approaches is not visible from ordinary distance. You have to be inside the room to see it. And most people are never in the room, not because they lack intelligence or discipline or ambition, but because the room has no signage and the elevator requires a key card. The lesson. Now you are working on something larger than anything you have encountered before. An offer has arrived for a holding that carries embedded appreciation of nearly $2 billion. The tax exposure, depending on structure, ranges from $380 million to $560 million. You are threading liquidity and tax deferral through the same structure simultaneously. The legal architecture spans multiple jurisdictions. 3 weeks ago, a similar structure at another family office was challenged by tax authorities. The outcome is not yet known. You are building something that might not hold. You are building it anyway because the alternative, paying the tax, surrendering the asset, accepting the permanent subtraction, is not acceptable to the people whose interests you serve. The markets open tomorrow. The answers arrive in 3 weeks. The exclusivity expires in 6. You hold the mat. You do not own the toll roads or the city blocks. Another family is waiting with another embedded gain and another set of questions about how to preserve what they have built. The game continues. And the lesson, when you trace it back to that first Tuesday afternoon in an office with no signage, is simple enough to state in a single sentence. The wealthy do not sell, and now you know exactly why.